Recently, we've been treated to a slew of negative and concerning news regarding the state of the US economy. On Tuesday, a report in the Wall Street Journal showed that consumer sentiment plunged to a near-record low this week. Consumer expectations fell to the lowest since October of 2011, a monthly survey by the Confidence Board showed. That measure sank to 54.4, well below the level of 80 that the research group says often signals a recession ahead. Consumers' assessment of the current economy also declined. The index sank to 86, below the 87.3 that analysts polled by the Wall Street Journal had forecast. And then on Wednesday, we learned the US economy had shrunk for the first time in 3 years. According to Business Insider, US real gross domestic product fell at an annualized rate of 0.3% in the first quarter of 2025. Gross domestic product is the total monetary value of all finished goods and services produced within a country. It includes household spending, investments, government spending, and exports minus imports. What we saw on Wednesday doesn't necessarily guarantee that a recession will happen, though. The last contraction was in the first quarter of 2022, which did trigger fears of a recession that ultimately didn't materialize. But historically, it's been understood that the definition of a recession is 2 consecutive quarters of negative GDP growth. Although not everyone agrees with this definition of a recession. In order for something to be declared a recession, a nonprofit, nonpartisan organization called the National Bureau of Economic Research determines when the US economy is officially in a recession. An NBER committee made up of 8 economists make that determination, and many factors go into that calculation. In 2025, it hasn't mattered what your investing strategy has been. The only investment that hasn't done mediocre this year is gold, which is still performing well. Silver and a couple of other materials are also doing well this year. But whether you pursue index fund investing or day trading or dividend/income investing, there isn't a sector that hasn't been negatively impacted so far. Specifically for dividend growth investors and income investors, there are some risks and considerations that we need to keep in mind, including things that other investors don't need to take mind of. What we're currently going through right now in the markets highlights what makes dividend investing and income investing so appealing. People who are retired right now and are relying on selling shares of their positions to fund their lifestyle are now being forced to sell more shares of each holding that they have. And if the market stays down for a long time, then a lot of people who depend on selling shares of their index funds and growth stocks are going to blow through their retirement savings significantly faster. For those of us who love to invest for dividend payments, we don't have to worry about share prices like pretty much every other investor does. Basically, most investors who aren't pursuing a dividend or an income investing style, they are struggling with their portfolios right now. Now, I will admit that I think there has been a tremendous amount of fear-mongering going on here on YouTube and other platforms. Many people are comparing what's happening right now with the great financial crisis between 2007 and 2009. It makes sense because only briefly during the COVID pandemic have we experienced a recession. But investors need to keep in mind that the GFC was significantly worse than just your typical recession. It was the worst economic event since the Great Depression in 1929. From then until 2008, we had never seen a recession last as long, which lasted for 1 year and 6 months. I don't want to downplay how severe things could get. What we're going through right now could end up becoming much worse. But recessions are a fact of life that investors can't avoid, and you shouldn't run for the exit just because one's happening. Recessions happen on a regular basis, about once every 6.5 years according to experts, which sounds surprising, but it shows how long things have been good. As they say though, these are odd times, and it's always possible that things could be as bad as they were back in 2008. But with all this in mind, and based upon the conversations that I've been having, a lot of income investors have been interested in potentially rotating out of certain stocks or even investment types and using the funds to buy safer holdings with comparable dividend yields. I've been getting these kind of questions on a regular basis this year. People are coming up to me and they're asking, what is the safest sector to invest in right now? What kind of investment can I put my money into that's currently yielding 8, 10, or even 12% or more and is risk-free when it comes to dividend cuts? It's important to keep in mind that there are no safe places during recessions. There won't be a single sector that won't be impacted in some way during a major bear market. And depending on the severity and the length of the recession, income investors should be willing to accept the fact that they could likely experience a dividend cut or more in their portfolios. If a dividend cut does occur, then it's not the end of the world, as many companies are able to regrow their distributions over time again. But with recessions comes the elevated risk of dividend cuts. It's the harsh reality, but this is why it's now more important than ever to diversify your portfolio across different holdings and different sectors. All of your colleagues who invest for share price gains aren't going to make it out of a recession unscathed. Some of their investments will tank and could even go bankrupt in a recession. The vast majority of the holdings that I have make up less than 5% of my overall portfolio. Only 4 of my investments currently make up more than 5%. When one of my positions, PCM, announced a surprise 20% dividend cut earlier this year, my income wasn't that negatively impacted. That holding currently makes up only 1.84% of my overall portfolio, and I haven't sold any shares between the dividend cut and now. But it was a great reminder on the importance of diversifying your dividend portfolio. If you hold a decent number of positions, you will eventually go through a dividend cut at some point. As I've been saying, if you're concerned about a serious recession, I would recommend going in more on ETFs. These investments offer easy diversification, and fund managers make updates to their holdings for you. If you only hold individual stocks, I would recommend holding at least 20 different positions and across many different sectors, including business development companies, closed-end funds, master limited partnerships, and so on. Over the years, I've known plenty of people who have just fallen in love with one particular company and they'll dedicate 20 or 30% of their dividend portfolio to it, especially if that company has a perfect dividend track record up to that point. But this isn't a good idea. You should be spreading your money across more holdings. The only thing we can do is monitor the financial results of dividend stocks and consider making adjustments as time goes on. There are some high-yielding sectors that could face more pressure if we enter a really ugly recession. The very small REITs, like the ones that only have a couple dozen properties, are more likely to face pressure because it won't take as many vacancies for their dividend to be at risk. Generation income properties was one of those examples. The larger dividend aristocrats in this sector would be what I'd suggest going towards if you're really concerned. The Realty Incomes, the Federal Realty Trusts, and the Triple N REITs, and so on. Preferred stocks and ETFs that hold them can fare better, but even conditions can go bad for these investments as well. My preferred stock ETF, ticker PFFA, had a dividend cut back in 2020 before I started investing because some of its preferred stock holdings had to temporarily suspend their dividends due to COVID. Like I've said, preferred stocks have a higher priority than common stocks, so a preferred ETF to go through something like this was pretty surprising, but it shows that this isn't a risk-free 10% yielding investment. Business development companies would likely see more pressure. Ideally, what should happen is if a recession starts, the Fed should lower interest rates as a way to entice companies to seek financing. It should also help companies from going on non-accrual status, but it's really going to depend on each BDC's investment portfolio. So to summarize, we can't predict if there's going to be a recession, although most seem convinced that it's likely. Depending on the severity, there won't be an investment type or sector that isn't going to be impacted. And unfortunately, experiencing a dividend cut is something that dividend investors should have to watch out for, because there will be a greater risk of that happening. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.